It's a good evening, guys. It's a beautiful evening. Tonight we look at the statements of cash flows. So we are discussing this fantastic question this evening under statements of cash flows. So, guys, you guys are gonna enjoy this part because it's one of those practical things that usually happens one of those things that usually happens, especially in practice, when it comes to statements of cash flows. So you guys are gonna really enjoy this one part because it's just quite fantastic and it's awesome. So what we're gonna do tonight, we're looking at statements of cash flows for a company that is ZPLC. So if you want to join the conversation, feel free to simply WhatsApp the number that is on the in WhatsApp that number there, so that you can join the conversation, so that you can get a copy of what is going on, or you can simply click on that link to come live on the screen, so that you may be able to be part of us. So, guys. This is one of those sessions where you definitely do not want to miss, but because we are looking at a real statements of cash flows. So I'm going to ask you guys to participate and ask questions as we go through the actual statement of cash flows to see how this is going to play out. All right. So we're looking at the statement of cash flows. And guys, I encourage you to participate and ask as many questions as you can. Right. So I'm going to share my screen so that, yeah, I'm going to share my screen so that you guys may be able to, follow through. Okay. So I'm going to share my screen, and here's what I'm going to do. Um, yeah, so I'm going to share my screen so that you may be able to follow through. All right, so let's go. I'm going to share my screen just now so that we can follow through and discuss this fantastic question. Okay, so there we go. Okay, so we have that statement of cash flow right about there. Of course, that's the statement we want to analyze. Okay, that's the statement we want to make sure we understand and, of course, be able to analyze. So, guys, we're looking at that statement of cash flows, and we are going to be able to analyze it and understand what that statement is indeed about. So, guys, welcome, and I'm happy to have you this evening. So let's get started, guys. As you know, a statement of cash flows has been used for a lot of things. I'm going to tell you my personal story. When I went for my first interview, the director asked me why a statement of cash flow is such an important issue for a potential investor. This is a real thing. Usually, busy investors don't have time to go through the income statement, to go through all those kind of bits and pieces. All they do, they go to statements of cash flows, look at what is happening in this particular company, and off they go. They don't have, busy investors don't have time to start assessing the company's income statement. They have little time for that. So sometimes what they want is simply to look at the cash flow statement and be able to determine whether the company is worth of investing in or not. So it's such a very simple such a very simple thing to do. All right. So now okay, there we go. So now, as you can see on your screen, what you're able to see there is a statement of cash flow, a new statement of cash flow for this particular company here. So you can see we are dealing with ZPLC statement of cash flow for year 20x7 and 20x8. Then we are required, of course, to do what? We are required to simply be able to prepare a statement of cash flows for ZPLC in accordance with ICE number 7. We're going to use the indirect method. So that's the method we are going to use, guys, the indirect method. So first things first, if you are dealing with the statements of cash flows, it's important for you to simply start with the format, all right? Because that's the easiest. That is the easiest way to tackle it. And then the other one says, explain how the direct method differs from, of course, the indirect method, and why the direct method may be more useful, why the indirect method may be more useful than the direct method in practice. Okay. So we're going to discuss all those kind of things. Do not even stress about it. We'll look at those ones into much more better details. So let's get started and see how this one plays out. All right, guys. So let's go. Are you able to see my screen? Guys, can you see my screen?
Yes, we're able to see it.
Fantastic. Okay, good. So now, first things first. There's usually a temptation, especially with cash flow statements. There's usually a temptation, perhaps because you may want, if you're not careful, you may want to start, waffling around and things like that. But my personal advice to you this evening is that if you're doing statement of cash flows, the first thing you want to do here is simply go and create a format that simply works for you. Okay, create a format in accordance with number 7, and then begin to punch in the framework. So first of all, don't think. The first thing you want to do is not to think. Simply ignore all this information, blah 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 blah. Ignore that information because it's just going to confuse you. What you're going to do in this context, you want to simply stick to what's going to work best. And what works best for cash flow statements really is this guy here, the statement. So now let's create the statement that is going to help us. First of all, make the format, create the statement, and that is where your power lies, because that gives you the opportunity to be able to just dismantle and dismantle and dismantle. You're gonna enjoy this one, guys, and I'm gonna show you the Lusambo way of doing things under this one. So you have a question, type it in, let us know how you are going to find this one. Anything, let me know. So first things first, guys, all you do here is simply come and do what? Simply come and do a format. So I have already made a format in advance to save time. So I'm just going to show you the format and so that we can move fast. So I have made a format already. So here's the format that I've made so that we can simply we can save time quickly and of course be able to move fast. So I have this format here that I've made. So you can see that's my format there. All right. So I've made a format that can help you follow easily, quickly, so that you can understand. So first of all, if you are told you are preparing a statement of cash flows under indirect method, what you do, you want to make a format. So the format goes as follows. You have to bring the profit before tax. This is all you do. All you do simply put it there. I'm going to show you where this one is coming from. The next thing you do, put non-cash item adjustments. Now this one is extremely important because now here the whole idea of a cash flow statement is for us to see what the money was before we made any adjustments. So now under this part, this is where you want to do what? This is where now you just want to make sure that at least everything works according to plan. Okay, so you don't want to mess up this one. So you put that one. So under non-cash items, one of them is depreciation. Depreciation is not money, guys. Simply a number on a piece of paper. So it's not money. You reverse whatever happened. You're going to put interest. Interest also is a non-cash item. You're going to put a disposal, either profit or disposal loss. All right, and then you're going to put amortization. So I usually advise you to leave at least 2 to 3 lines, just in case there's something in those notes we looked at. So that's where the story is, guys. Leave 2 to 3 lines, just in case there's something that you did not understand. That is key for you to understand. Okay, is there anything else? Yes, there's something else. Something else that you want to do here is go to the operating activities. Now you simply put the inventories. Did the inventories increase during the year or did they reduce? So simply put inventories, receivables, and payables. You're going to decide afterwards whether the inventories increased or whether the inventories decreased during the year, or whether the payables increased or they decreased during the year. So these are real issues now. These are actual real things that you want to pay attention to. So once you put the non-cash items here, these are non-cash items. All right. So once you work with those non-cash items, what do you do? So there, I think I'm just gonna give it a much more mild color like that. I think there. you leave them. Then you come to these guys here. These are real actual items. These are cash items. These are actual things. These are the things that you've been working with. So I'm just going to give also this one a different feel, just for us to be able to separate them so that we know, okay, here we're talking about this, and then you're talking about that one. What do you do next? Interest paid. Simply bring interest paid, tax paid. Simply make a format. Don't think about anything in the exam. Just come make a format so that you can deal with all these things. It's not complicated, guys. You're gonna love this. You're going to enjoy yourselves, but because this is extremely fundamental for your exam. So you do something like that. You have interest paid, tax paid, it's a working. Also, that one is a working, very domestic working. And then what do? You jump a line or two. I usually leave a line or two just in case there's something in the exam. Next thing, what do? You go to now cash flow from investing activities. So now this is where the cash flows from operating end. So if you look at here, cash flow from operating activities are here. All right. So that's the part where you put all those non-cash items and all those kind of domestic stuff that we've been talking about. So they come under cash flows from, of course, operating activities. So you put all those kind of things there just to make it easier for you, and of course things like that. Okay. Anything else? Yes, there's something else. Now you go to investment activities. Now, under investment activities, you ask yourself one question. When you have money, what do you do with it? The question is, you invest the money. Where do you invest your money? Of course, you put your money into PPE, all right? You want to buy assets. Sometimes you have some projects you are developing. And of course, sometimes you simply want to sell some stuff to get more money so you can invest to enjoy it yourself. So you may want to put PPE on the format, and of course things like that. So you want to do that, PPE and all those kind of things. So you put the format. Purchases go under investment. All right. Developments, any projects you're running, under investment. Those are investments. Proceeds from sale of non-current assets. Sometimes as a business, you have assets and then you sell them to other people. All right. So when you sell assets to other people, what do you do when you sell those assets? You simply record, okay, I've sold these assets of so and so, then you enjoy it, your benefit. All right. But again, remember, once you do the investment activities, leave a line or two. What I'm giving you here, these are the basic ones. These are the general things that you are most likely to see on the statements of cash flows. So you put all these things in order, all right? Make sure you understand what is going on. Don't waffle around. Simply make a format. It's easy. Don't think. Remember what we said. Don't go to those things I told you about. Don't go there to waffle around. Don't think. Don't stress. All you are supposed to do here is simply to do just that. Then after you invest the money, what do? You check the financing activities. Where is the money you're investing coming from? So a cash flow statement shows you three things. It shows you where you took your money, where you got your money, and how you performed with that money. So there are three things that you're going to see: operations, investments, and financing. So how were your operations? How were your investments? How did you finance your business? So sometimes in real life, we finance our businesses using shares. All right. If you're a PLC company, you may want to finance your business using shares. And apart from shares, sometimes you finance your business. Of course, apart from shares, you may want to use debentures. A debenture is simply a loan with interest. All right. It could be given to the public, investing public, or you could be the one participating in the investing public. So it's simply a loan with interest. But again, sometimes remember there's a dividend coming there. What does that mean? It means the people that helped you get that money for you to invest must get some sort of reward, which is a dividend. So when people finance your business, you pay them something, a dividend. So what do? You have shares here, you have a lease. Sometimes you finance your business by means of a finance lease or by means of a lease. Sometimes use a debenture, and people help you finance your business. You pay them something called a dividend, which is simply their benefit for taking that particular risk. Extremely easy to follow. So this is what happens under statements of cash flows. Three important sections: operations, investment activities, and financing activities. Then last but not the least, you should come and now do a review here at the end. You say, okay, fine, how much money did I start my business with? Okay. Sometimes when I do that, you want to ask yourself a simple question. Okay, fine, how much money did I come with? So you came with cash and cash equivalent. A cash equivalent is anything that is equivalent to cash. For example, a check. A check is a cash equivalent. It can easily be converted into cash. A government bond could be a cash equivalent. All right. Those are commercial documents are cash equivalent. So a cash equivalent is anything that you can go to right now and convert it into cash. So now what you want to see at the end is how much did I come with? So you have the opening cash and cash equivalent. Then you have the closing cash and the cash equivalent. So you want to compare the money that you came with when you're starting the year and the money that you are closing with. What's the difference? Is there an increase or is there a decrease? So you want to find out what has happened to your cash. So once you make this format, what do you do next? Now you go and start posting the free marks. Extremely, extremely dongalistic. Again. So you stick to the Lusamba way. Don't think at this point. Just make the format. Don't think about anything. And go to the income statement and the SFP. And then begin to post those free marks. So guys, for us to move fast, what I'm going to do, I hope you've copied this format, so that when I begin to tell you the figure for depreciation, you simply start posting interest to begin to post and things like that. So we want you to keep posting and posting and posting. All right, so is there something else? Yes, there's something else. Remember, there are only three things to understand on the cash flow statement. The important thing you're looking at as an investor here is how is this company performing with the money that they have, the things that they have, their operations. So here, these are the operations. Remember, cash flow from what? From operating activities. This is the part here. You want to understand this company's what? This company's operations. What are their operations? Then you look at the profit before tax, the one that they had. Now what do? You remove the non-cash items. Now, sometimes when you are asked to assess performance, what we do on the operations, we remove the dividend from here to see if this company, from the money they are making from their operations, if we subtract a dividend here, how much money are they going to remain with to invest? So that is important. So when the examiner tells you to assess, for example, the performance of this particular company, or maybe a financial analyst, you have a client who wants to assess the performance of this particular company, you may want to try and remove a dividend from here. So you put dividend come somewhere down there. Yes, my friend. In the other side. Thank you so much. Yes, here. So that's what you do. Okay. That's what you do. What do? You want to put the dividend somewhere there so that you can come and assess. That's extremely, extremely important. Okay, extremely important. But again, for the purpose of this statement, we will not remove the dividend from here. All right. Yes, my friend. Okay, close for me. Close for me. Brian, come. So that's what you want to do. All right. So now let's get back, guys, to the actual scenario. All right. Now let's get back to the question. All right. Come this side, my friend. All right. Yes. High five. Okay, good. Yes. Yes. Thank you so much. I'm gonna see you soon. All right. I'm gonna see you soon, my friend. So, guys, that's one thing that you want to understand there. All right. So now, after you've made your format, what do you do now? Now you go and begin to pick up all those free marks. Okay. So now, what do you do with your free marks? How do you pick them up? So now you come down here, right? So now what we do, we go down here and we come and pick those free marks and we begin now to post them. Where do we post them? So we come down here, say, okay, fine. Let's post those particular free marks. Remember what we said? On that format, there's interest, there's profit before interest and tax, there's all those kind of things. So what do? You simply come down here on the income statement, and then you check for the profit before tax. Okay, this figure there, the profit before tax, the 342. You go and paste it on that format there, profit before tax. Anything else you're going to post that is free, the interest, the finance cost. All right, you reverse. So interest initially was subtracted in the income statement. So what do? You're now going to do what? You're now going to add it back so that you can reverse the transaction. Here they subtracted interest. On the statement of cash flow, you do the opposite because it's not a cash item. It's a non-cash item. You just want to see what the cash was before they removed interest or before they did anything. You just want to see the actual cash that they had before anything else, right? So you go and post that one down there. All right. So what do you do there once you post? Let me just show what that one looks like. This one looks something like this. Let me just show what that one looks like on the statement. So I hope you guys are posting on that particular statement. Okay, so what does that look like? It looks something like this. So if you go on the statement, you're going to find that it looks something like this. Okay, so there we go. Okay, so there we go. It looks something like that. So you have the interest here, you have the profit before tax there, you have the interest, the 15 there, you put it back. The next thing you want to do, you want to post a depreciation. All right. Dip is a free mark and it is always found where in the notes. You don't have to think. Just go in note number 1, 2, or 3, one of those 3 notes. That's why dip is found usually. Go and read, pick it up, paste it there, home and dry. You don't have to stress about this one. Okay. The next thing you do, you want to go and get either there was a disposal profit or a disposal loss. All these are found where in the notes. You don't have to think about it. You don't have to stress or calculate anything. The examiner always gives you, all you do just go and pick them up and put them there. So you don't have to stress about anything or anything like that. All right, so let's go and do just that. Let's go to the notes and see what's happening in our notes so that we can post those things. All right, so let's go and see those things. Okay, so now what we have, we go down here, we go to our notes. We go to our notes, and what do? We come down here on our notes, and of course, we share the income statement so that you guys can be able to look at it. All right, so that's our income statement. There we go. So you simply come down here. Then you say, okay, fine. Why is depreciation? Like I said, dip is between 1 to 3, not number 1 or 2 to 3, somewhere there. So we're going to find dip. So what do you do with that dip? You simply come down here. You read. Note number 1 talks something about development. Note number 2 has something to do with PPE. That's where dip is found. So simply read. During 20x8 items of PPE with a net book value of 103 were sold for 110. All right, so they made a profit. They sold an asset which they had. They made a profit of 100 and they made a profit of how much? Of 7,000. It was 103. They sold for 110. Remember, profit is not cash. Profit is simply a number on a piece of paper. So this is a non-cash item. What do? You want to go and do a reversal. Okay. The next thing you want to look at, every time you sell an asset, common sense tells us that you must remove its depreciation to avoid overstating the depreciation. So you are also told dip charged in the year on PPE, total how much? 57,000, and then there's a full stop. You end there. Those are the three things you get. You're going to get the dip 57 and also this 7,000, which is the profit on this calculation. What do? Once you get that one, all you've got to do now, simply get back to your format. All right, get back to your format, and once you get back to your format, simply go and paste those. Those are the freest of marks. You don't have to stress, don't have to think. All you do, simply pick those things up and then go and paste them without stress, without thinking about anything or things like that. So what do? You come down there and then you paste. So here you're pasting how much? Dip 57. Don't have to think, because dip is an expense. It reduces your profit. So when you are dealing with non-cash items, you add it back to reverse the transaction that was taken in the income statement. So you've reversed the dip, you've reversed the interest. Now see the disposal. Now you know it was the disposal profit because the asset at the carrying value of 103, and then it was sold for how much? 410. So what do? You made a profit of how much? Of 7. 7 is a non-cash item. It is not real money. It's simply a number on a piece of paper. So any profit that you make from a sale of NCAs, what do? It increases your profit. So in the income statement, this number is added. So now here, what do we do? We reverse the transaction. We are going to remove the 7. So the 7 now is being removed because in the income statement it was added. So all you do, whatever was added in the income statement under non-cash items here, you remove it. Whatever was removed in the income statement, when you come here, you add it back. That's how it works, guys. That's how it works. All right, so now we have a statement of cash flows for now we have the profit before tax, we have the depreciation, we have the interest, we have the disposal profit. Now we have this young lady called amortization. So I'm gonna jump because this is a working. So we're going to come back later to amortization after some time because it's a working. So all I'm focusing on for now are the free things. First, we get the free things, then we're going to come back to calculating stuff. So you come to the other aspect here. So you leave 1 to 2 to 3 lines here. You leave 2 to 3 lines. Then you come here. You want to check the inventories. How were the inventories that they came with? Did they come with more inventories or did they come with less inventories? What happened, excuse me, during the did inventories go up or did inventories go down? All right. Now, these are real issues. These are actual cash items. So now these are actual cash items. So what do? You go and check the statement. Now you guys have got the statement that I've given you. You tell me how much inventory they come with, guys. How much was the inventory? Those of you who are following us, you can simply WhatsApp the number in the comment to get the question if you want to follow through. So how much is the inventory? So what do? Simply go to the income statement to go to the SFP to go and fish this one out. It is extremely easy. All you do, go to the SFP, all right? Go to the SFP, guys, and fish those numbers out at once. All right, you don't have to stress, just go to SFP and say, okay, fine, I want to fish these numbers out. So what do? You come to the SFP up here. You want to see how much inventories they came with. Go to SFP under current assets. Okay, then you look at inventories. In 20X7, of course, they came with how much inventories? They came with 227. In 20X8, they were closing with how much? 360. What does that tell you? There's a difference here. Inventories have gone up, all right? They opened with stock of 227. Now they are closing with a stock of how much? 360, right? What does that mean? It means they ordered more. They bought more stock. If you have 227 stock, now you have 360. What that means you've ordered more. So these guys ordered more. Now, when you order more stock, what does it do to your bank account? Your bank account goes down. It's a cash outflow. When you buy stock, you are taking money out of the business. That is the logic understatement of cash flows. So money out of the business is going out of your business. So now what do? You are going to do what? You're going to indicate a negative balance in the statement of cash flow. All right, you're going to show that actually cash of 133 left the business. Okay, because from 227 you now are closing with the stock worth 360, which means you bought more stock during the year. Now, when you buy more stock, money is leaving the business. Now, the next thing you go to is a receivable. Receivable represents people that owe you money. So when you came in 20X7, you had 324,000. Okay, people are owing that amount. At the end of the year, you are closing your year, you discover only 274 are owing you. What has happened? If 374 people are owing you, now you have 274. It means 50 have paid you. That's a cash inflow. When people who owe you money are paying you, that is increasing your bank account. So it's a cash inflow. That's how you deal with that. Then, so now we have an increase in inventories. We have a decrease in receivables, and now we go to our payables. What do we have on our payables? We go to current liabilities and check our payables. Our payables, we came with 352. Now we have 274. So when you started the year, you owed 352 to people, and now you are paying them how much? Now you are owing how much? 274. What does that mean? It means you've paid some money to people of 78,000. That means your cash has reduced from your bank. So you've gone to your bank, you've gotten money, and you've paid the people that you owe. That's what it means. So that is the cash outflow. There's a decrease in payables. So what do? You now simply go and show this thing where you go and show this thing on the statement of cash flow. So what do? You go to your cash flow statement and you go and show what has just happened. So all you do, you go to your cash flow statement, and then you say, okay, fine, I'm going to show what has happened here. So you come here and then you show your statement of cash flow. So you say inventories, there was an increase from 227 to 360. So what we have is a 133 cash outflow. Then you go to receivables, there was a decrease where people were owing us how much? 324. Now they're owing us 274. So we received about how much in our bank? 50. Payables, there was a decrease in payables, all right? There was a decrease in payables, guys. So payables decreased, all right? From 352 to 274, you paid people you owed 78. It's extremely dongalistic. It's amazing that some people fail to come up with statements of cash flow, partly because maybe they were told by some people did not understand these things that they are difficult. They are extremely understandable. This is what we do in real life, guys, for real companies, for real clients. So now you get that figure there. So it's okay, fine. Now I know my statement of cash flows. Okay, fine. Now remember here, when you dispose of an asset, all right, you must show that you received some money from something that you invested in. So this 110 here, the one that you received, because the asset was sold for 110, but it was worth 103. So you must come down here on proceeds from sale of non-current assets. Okay. So the proceeds from self-non-current assets, all you do, you simply show a 110, the money that you actually received, because you received 110 for selling that particular asset. So money came into your business, a cash inflow. You must show it under investment. You know what? I had an asset, I sold it for 110, and here's the money. But if you notice here, the profit was how much? Was 7. What that means, it means you've simply done a double entry to show actually the real value is how much for the asset is 103. Because here you're removing a 7 and here adding back a 110, it simply takes you back to the carrying value of 103. So guys, are we okay so far? Any question, anything like that? Are we safe? We can continue. Guys, are you safe? Are you okay? Mpande, yes, sir, Mr. Mwaba, are we safe?
Yes, we are okay. We are there.
Fantastic. Okay. So, Mr. Matthews, I'm unable to bring you on screen. I'm not sure what is it with your camera. You have to enable your camera for me to bring you on screen. So sorry. Guys, you are following us live. If you want to join the conversation, simply click that link in your comment to come live and be able to ask live questions. So there's a link that we have shared in the comment section. That link there, it can bring you live so that you can come and ask questions if you want to ask questions. So there's that particular link that can be able to help you. All right, so there we go. Okay, so now after we have done with that one, what do we do next? We go now to the next aspect. Where's the next aspect? The next aspect now is this one here. We go to interest paid and also we go to tax paid. But usually in the exam, I don't think I advise you to do that because first of all, I want you to get what is free first. Okay, you get first the free marks, then you can go there. But either ways, we can simply follow it like that. But in the exam, I advise you to simply, what do? You simply come and get the free things. For example, this last part here, this one is a free part, and also dividends are free because they are given to you in the notes. Debentures are also very free. So you want to get the free things first. But for the purpose of being able to follow, I'm going to go step by step. Development expenditure also free. You want to get that one from the notes. So now let's go and do the interest. Now interest paid is a working. So what do? You go to income statement. I think I'm going to the income statement, guys. There. What you go to income statement? You take the figures for interest and for tax. All right, so that you can do an interest calculation and the tax calculation. So let's go to our income statement so that we can do this particular working. There's working number. I did these ones already in advance to save time. There's working number 2 and working number 3. I already worked those ones out so that we may just be able to save time. Okay, so there we go. Okay, so I'm going to put these ones in green to show you that these are our workings. Okay, I'm going to put them in green. I'm gonna put these ones in green just to demonstrate that they are workings. So I'm gonna put all these things in green here. Yeah, and I'm gonna put these ones also. Yeah, I'm gonna be putting them in green just to show that okay, this is what is happening. All right, is there anything else under interest? Okay, interest is here. So yeah, I'm gonna put it in green as well, just to show. Yeah, okay, fantastic. So now let's go and fish out the numbers. Where are we getting these numbers for interest? 0, 15, 5, and 10. Where are they coming from? These guys are always a free mark. You don't have to stress, you don't have to even panic. All you do, go to income statement, go and fish them out. And you are going to enjoy yourself. You're going to like how this is fished out. So let's go to income statement and fish these things out. They're extremely, extremely donglistic. They are free marks. You want to enjoy yourself during this process. Okay, so now let's go to the income statement and fish those figures out. All right, so we go to the income statement. Okay, so we go to income statement, we go and fish those figures out. What do we do? So we come down here, the income statement, and then we say, fine, let's fish those figures for interest out. Interest is down here. This is our income statement. Now, interest for the interest for the year is 15. We already know it's this one here. So now all you do, simply go and check the SFP current liabilities to check for any current interest here, current liabilities. So now you're going to see that we have a debenture here. A debenture attracts interest. This is current interest. They opened with 0 interest. Now they have 5. Then the income statement shows how much? 15. So what do? You simply make a format now here. Okay? You make a simple format to help you work that one out. So all you do, you make it a simple format. You come down somewhere here, you make that particular format. What do? You come here. Then you say, okay, fine. Interest, they brought forward was how much? Was 0. Then anything that they incurred during the year in the income statement, they incurred 15. So you add what they opened with to what they incurred during the year. How much did they close with? The carry forward was how much? Was 5. So remove 5 from 15, the balance is 10. That is the amount of interest which they paid. That's how you do the interest paid. Extremely, extremely donglistic and quite free. So then what do? You go up here, you come and say working number 2, interest paid was 10. Now when you pay interest, money is leaving your company. So that's a cash outflow. So you indicate a 10 to show it's a cash outflow. You do the same for taxation. Taxation as a format. And the format for tax is nice. Why I like the format for tax is partly because it brings 2 things to mind. Remember, guys, I've not used the T account for interest. All right. If you want, you could have used a T account. For a T account, it could have looked something like that. Okay, something like that. You could have come, they brought forward somewhere here. What was in the income statement there? They carried forward somewhere there. The balancing figure would have been a 10. So this could have been what? That could have been of course could have been what it could have looked like. So let me just change the color there just to give it a different feel so that we should not mistake it for anything else. Okay, so that's how it works there. So it could have looked something like that if it was a T account. So I'm just going to show that this was a T account. It would have looked something like that, right? But anyway, it's not going to look anything like that. Okay. What else do we have? We have something here. We have tax. Now for tax, tax is interesting because for tax also there's what you call current tax, opening current tax. Then there's also opening deferred tax. Then you add whatever tax the company was charged during the year. Oh, that is 162 there. Okay. Whatever tax the company was charged, you add it during the year. Then you subtract whatever current tax the company closed with and whatever deferred tax the company closed with. So the difference is what was paid. If you want, you can do the same and do a T account exactly like I did here. See, this is a narrative. This is a T account. This is also interest. It's a T account. I did double to just show a student. If you want, you could have done like this, or you could have done like that. So now here when you look at tax, just remember that important thing. Tax has two things. There's what you call current tax, then there's what you call deferred tax. So get both the opening balance for current tax and get the opening balance for deferred tax. Now that helps you a lot. The current tax opening balance plus deferred tax opening balance. So just let me just go and do this. Maybe let me do this. Let me say opening current tax and then opening deferred tax. All right, opening deferred tax like that. So here I'm gonna say closing current tax, and then here I'm gonna say closing deferred tax. Then this one here is the one that they incurred in the income statement. So simply get the opening balances, and then you add. Of course, you wanna add what they opened with in the income statement. So here, if you want, you can make a total if you like. All right, you can make a total of the opening balances if you like. You may make a total of the opening balance. All right. So if you like, you may make a total of the opening balances. If you like, you may make a total of the opening balances. Of course, you may want to simply do that. Oh. Okay. So you may want to do that. So that's the total there. So you may want to do that. So that's the total. 360 from the opening balances. So what they opened with and what they closed with. All right. Yeah. Okay. That's our formula. That's our formula there. Fantastic. Yeah. What is that now? Okay. Okay. So I'm just going to do that. Yes. Okay. So that's our figure there. All right, guys. So anything else that we have? Now you go back and check the closing balances. The closing current tax was how much? 56. And of course, closing fair tax was how much? Was 48. Or you do simply total these ones up, you have this one. So now you get this one plus this one, then you remove from that one. So if you want, you could have done something like that, where you say, of course, simply make a simple total there, something like that. All right, you could have done something like that, and then you could have entered that figure there. It could have shown you, it could have been 104. 104, if you remove from that amount, it gives you 256. That's how this thing works. Okay, that's how it works. Okay, guys, so you could have done something like that to get the tax. Now, you may be wondering, but where are the tax figures coming from? So now let me show you where the tax figures are coming from. So what do you do? Let's go to SFP and the income statement so that we can fish out the tax figures. In the income statement, you're simply fishing out what happened during the year. On the SFP, you're getting the opening balance and the closing balances. It is such a very easy task to do in the exam, or when you're doing with a client. That's quite a very simple task to carry out. All right. Okay. Good. So there we go, guys. What do you do? Now you go back to your income statement to go and fish things out. Then what do? You simply come down here and then you say, okay, fine, let's look at the tax. So that's the tax there. All right. So the tax that was paid, you go to current liabilities. Current tax, they opened with how much? 153. That was the opening balance. Then you go to deferred tax under current liabilities. They opened with how much? 45. That's where these numbers are coming from. Opening deferred tax plus current deferred tax plus what happened in the income statement. How much tax did they pay in the income statement? You come down here. Tax expense was 162. That's where that number is coming from. So it's a 162 plus 153 plus 145, you make the total. And then you get the difference from what they close with. Why is the closing current tax? They close with 56, you less it. Closing deferred tax was how much? 48, you less it. The difference is 256. That's how we are getting that calculation, guys. So that's how you do with taxation. Guys, everything okay? Are you okay with how we are getting that?
Yes, we are okay.
Fantastic. So that's how you do the tax, guys. That's how you do the tax. It's extremely understandable. It's extremely straightforward. So there we go. So the next thing you do now, you want to go and do the other aspect of your SFP. So what you do, you come down here and then you say, okay, fine, which one is the other aspect? So now you've dealt with taxation, all right? You've dealt with taxation here. You've dealt with taxation. So now all you want to see now here, you want to come down here and take a fine. So you've done with this part, interest and tax. Now you come to PPE. PPE is another calculation that you must pay attention to because it's extremely important. So now under PPE, it's the same thing. All you do, you go to SFP under non-current asset. You pick all the PPE that is there. You bring them here. Then you go into your notes to see if they sold anything or if they bought anything. You add. All right. And then also check if they dispose of anything. You simply remove what they sold and the depreciation that for the asset that they sold. The difference is the PPE. If there was any lease, any property that they had, just total them up. So very straightforward. So all we do, we come to working number 5 to come and do PPE. So PPE is actually working number 5 and it's here. So when it comes to PPE, all you do simply get the brought forward on the SFP. I'm sure you guys can see your SFP right now. You can see this company came with how much on the non-current assets under PPE. They came with 637. And then you check if there was any revaluation that took place during the year. Yes, there was. There was 152. They came with 60, and then the assets were devalued to 152, which gave them a gain of 92. This 8 is coming from the income statement. So now we have a total revaluation of how much of 100. Any lease, yes, there's a lease in the note that they bought an asset 56 using a finance lease. You add it. So you come up with the total. Then what do? You remove the closing balances, the carry forwards. The carry forwards was how much? 825. They sold an asset for 103, and then dip was 57. So you remove these things. Then you're going to find the balancing figure is how much? 192. That, excuse me, that represents the amount of assets which they bought. So you bring that 92, you come and put it where? You come and put it under investment activities somewhere here. So some of you may be asking, but where are the numbers coming from? So now let me show you where these numbers are coming from. Okay, where we're getting the 637, the 100, the 56, and the 825, the 103, and the 57. The 103 and the 57, we are getting them from here. When you sell an asset, you must remove it from your books. The asset they sold for 110 was 103, so we're removing 103. It had a dip of how much? Of 57, we're also removing the dip to avoid overstating depreciation because it's going to reduce our profit. When you sell an asset, even this dip must be removed from your books. So that's where those two numbers are coming from. How about where these two numbers are coming from here? Where are these other numbers coming from? The 100 is in the income statement. The 56 is in the notes. This is also on the SFP. So let's go and check it out. The 152 and the 60 are also on the SFP. So let's go to SFP and check these things out. Yes. So what we do, we go to our SFP down here. Then we say, okay, fine. Let's check these things out. Okay. So we come down here. We come to check these things out. We say, okay, fine. Let's check these things out on our SFP. We come down here. All right. So what do we do? We go to our SFP. Then we say, okay, fine. Let's do that. Now, look at the income statement. The income statement shows you the gain on evaluation was how much was 100. So that 100 is coming from. Total. The income statement shows you the total, but the reason why I showed you what 152 and the 60 was for you to just understand where the numbers are coming from. Look at that. We have the 60 under evaluation here, which they opened with under equity section here on equity. They opened with 60, they are closing with 152. The difference was 92. All right. If you go to income statement shows you a total of how much? Shows you a total of 100, which means they had another 8, which was coming from somewhere where we do not know. So we simply get the total, which is 100, and put it there under evaluation surplus. How about the 637 for under PPE they brought forward? Yes. In 2027, under PPE and non-current assets, they came with how much? They came with 637. That's where the 637 is coming from. Plus the relief surplus of how much? Of 100. That 100 there. Then plus a lease. They bought an asset by means of a lease here. ZPOC transfers extra deep on evaluated property, plant and equipment to how much retained earnings as allowed by S number 16. So here we don't care. DIP based on historical cost in 20x8 was 49. We don't care because of that note there. Then Z purchased 56,000 of PPE. All right. By means of what? A finance lease. So this is our asset. What do? We add it on our asset. So we are going to say 56, this one here, plus of course the 100, the diff surplus, plus the opening balance of 37. Then we remove how much? We compare with this one, the 825, the carry forward, and then we're going to compare, of course, with what was sold. The 103, this one here, and the dip the 57. The difference is the purchases. So all you do, you come down here and then you say, okay, fine, let me see where these numbers are coming from. So what you do, you come here and then you simply go and post those things. Cash flows, guys, is really, really easy to understand. Yeah. So there you go. So now you come down here, say, okay, fine. Brought forward was how much? 36. The deviation surplus was how much? 100. And I was explained where these two numbers are coming from. Then the lease was how much? 56. They bought an asset, so you add it because it's their asset. Then the carry forward was how much? 825 plus the disposal of how much? 103 and the dip of 57. Then you get the balancing figure here, which is how much? 192. So 192 is the purchases, the balancing figure. So what do? You come down here and then you show 192 was the balancing figure. Then you go and do the what? The 190, the development expenditure. Now 190 is a free mark. It is found in the notes. All right. So all you do, the development are found in the notes. All you do, you go to the notes and say, okay, fine. Is there a note that shows that there the development that was going on? Yes, there was a note. All you do, what do? You go back to the question, income statement, to go and fish this thing out. Okay. So how do you fish it out? You come down here. You come down somewhere here. Okay. And then you fish this thing out somewhere there. Yeah. You fish that thing out. Okay. So if you fish that thing out, what happens? You come here and then you say development expenditure total how much? 190. It's a free mark. You pick it up and post it under investment activities. So it's a cash outflow. They spent 190 on developments. Okay. Is there anything else? There's a dividend that was paid. Dividend totaling how much? 156 were paid. People who helped you invest must be able to get some benefits. It's a dividend. You go and post. Free mark. So what do? You post that one. Anything else, you now go and check, okay, what is remaining now for you to do? Okay, what is remaining? You come down here and then say, fine, let me check what is remaining. And you come down here. You post there, then you say, okay, fine. So now you know what you have done. You know your development expenditure is done, your PP is done, your proceeds from current assets are done. Then you jump to your what? To your issue of shares, cash flow from financing. And here you know the dividend is done. That 156 is just a cash outflow. You pay the dividend of that. So now you go to share issues. Share issues, they are not here. It's a working. So what do? You go to read that particular note. You find out what happened so that you can understand it. A lease, we are going to do a working. A lease is a working here. We're going to do a working. Okay. A debenture, this is a free mark. Okay. We are going to pick it out. It's a free mark. So let's go and pick a debenture. We post it and then we pick shares and the debenture. Let's do that now. So you do that, you come here, you say, okay, fine, what's the debenture? You got the debenture there, you simply go and pick it up, bam, You're even relaxed at this point, you're enjoying yourself, you got the income statement or the SFP, you go and pick up the debenture like that. So you come here on the SFP, and you come in the SFP, what do? You have a debenture here. So there we go, 6% interest debenture. They opened with how much? 100. Now they have how much? 150. They have a gain of 50. It's a cash inflow. What do? You go and post that on another debenture. The difference is a 50. You post a 50. Now my interest on the shares. There's a working for shares because you've been told something here under shares. You've been told that during the year, Z made a 1-for-8 bonus issue, capitalizing its retained earnings followed by a rights issue. What does that mean? When you make a 1-for-8 bonus issue, you are telling people that, you know what, guys, for every 8 shares you buy, I'm going to give you one for free. Now, who is going to pay for this one share which you are giving for free? Because you can't give shares for free. These shares are listed somewhere on Luce, right? So now what you do here, you're going to use the premium account to pay for this particular share here. So it's 1-for-8. So all you do simply say 1/8 multiplied by the premium account. That's the easiest. I know the examiner uses his own formula, but I'm stick to what I'm telling you. Here, what you can do, I think it's shorter. Simply get the 1/8 and then multiply by the premium account, because it is the premium account which pays for bonuses. I think that's easier, and I'll just let it at that. I want to go to explain other ways of doing it. I think let's leave it at that. So all we do, we are simply going to go on our SFP and say, okay, fine. Where are our shares? We go to equity section here. Share capital, they opened with how much? They opened with the 400. Okay. Share premium, they opened with how much? 100. Then when you do with the share premium, they are how much? 350. So remember, 1/8 is coming from where? From the premium account. But before you do that, find out how many shares are they giving for free, because you can only issue shares from what you have, the ordinary shares here, which are how much? 1 kwacha per share. So from what they have here, they came with 400 shares, and they issued one for eight bonus issue. For every 8 shares which they issued, they gave one for free. So find out how many did they give out for free. So all you do, you can create a text somewhere here, and then you can say, okay, fine, let's do this. They came with how many shares? 400. Then you multiply this one by 1/8. It's going to give you how much? 50. So that tells you that this company did what? This company actually gave out 50 shares for free. So who paid for those 50 shares? The only guy who paid for those 50 shares is which one? The share premium. So the premium, they are closing with how much? So the premium is closing with how much? They have about 350. We remove how much? We remove a 50. They are going to close with about how much? 300. That's how we are going to do. So in the premium now we have 300. Or the other way you could have done, which I don't really like, you could have said, okay, fine. You could have said, okay, fine. You could have said, the other way you could have said, opening balance, they are how much? They opened with 400 ordinary shares, and then they opened with 500. How much? They opened with 500 share premium. Then closing balance, they have how much? They have 500 and 350. So what you could have done, you could have done something like this if you wanted. You could have said 850, that is 500 plus 350, 850, minus 400 plus 100, that is how much? That is 500. All right. And then you say this one minus brackets, you say 1/8, then you multiply by how much? Of course, 1/8 by 400. You could have done something like that. This also could have given you how much? It could have given you 850 minus 500. That could have been how much? That could have been 350 minus a 50 from there, which could have given you 300. Even that could still have done the job. So you could have either done the job on the first one or on the second one. But I think I like the first one because it's much more easier. So the shares are done. So now what do you do? You simply go and post that 300 on the shares. That's how you do it, guys. So you come down on the shares, you say, okay, fine, let me do the shares, let me go and post. So now you come down here on the shares, you say, okay, fine, I'm going to post the shares down here. Then you come here and post. So what do you have? See, under shares, you have 300, you've posted. This one is posted. So the only figure remaining now is where how about the 50 or the 50 is a debenture, we've done it already. They came with 100, they're closing 50. So now we're just remaining with this guy here. The 31, the lease. The lease is a working, all you do is working number what? The lease is a working, all you do come down here and come and do the lease working number 7. There we go. So the lease, of course, is a working. So I'm just going to do something like that. Of course, just to give it a different color. When you're dealing with a lease, do two things. It's the same as tax. It's the same as tax. Tax has got what is called the current and the non-current. Even a lease is the same. They have got what is called the non-current lease liability plus the current lease liability, the opening balances. Then you add new, something that they purchased during the year. Then you remove the closing non-current and the closing current. You have, they paid 31,000 in leases. So all you do here is also the same as taxation. You simply get the opening lease on the SFP and the non-current liabilities 12. You go to current liabilities. I think you can see that one, guys. I've given you the question already. Then you can now go to the current. You're going to find this 80. Then you add non-current plus current. Then whatever happened during the year, we have in the note 56. We've done this one already. You add it. All right. So if you like, you could even have done something like that. All right. You would have done something like that. Of course, you would have done something like that. And then you could have simply done that. Yeah, to just be able to get a number there. So now you know when you add this one plus that one, now you know you have a total of about 48. If you like, you could have done that one, right? So now you could have done something like that. A total of about how much? About 8. Yeah. Then you remove the closing balances. How much do you have? You have 100, you have 17. The difference is a 31. 31 is what was paid. So what do? You come down to your statement and then you say, in leases, we paid 41. So now you are done. There's just one question remaining, amortization. Amortization is a difference, is a result of what? Development expenditure. So it's a working again, working number 4. What do? You go to amortization. You look for amortization and say, okay, fine. Where is working number 4? So that you can do amortization. Okay, yes, I did this one already. Uh, yeah, so amortization is there. Okay, fine. So now we have amortization. It's a working already. You don't need to stress about this one. Simply go to the SFP. There's always a brought forward. It's a free mark. Pick it up and then add the expenditure during the year. It's in the notes. We did this one already. This is the figure here. The expenditure 190. We did this one here. The expenditure. It's in the notes. You pick it there. You add it to the opening balance, and then you remove the closing balance on the SFP. You have 60. You are done. So that's how you do the amortization. It's a free mark. Now, where I'm interested is not on this one. My interest, guys, is my interest is on this one. My interest is on the last part here. The last part. The opening cash and cash equivalent plus the closing cash and cash equivalent. These are free marks. Or you do make a format. Simply say this is supposed to be working number 1. Okay. So you say, of course, you have opening cash and cash equivalent, closing cash and cash equivalent. Let's make a format So you say, what is cash component? Opening cash and closing cash. Then cash equivalent, opening cash equivalent, closing cash equivalent. And then you remove the overdraft, the bank overdraft, what they owe. Right? So that you can come up with the total amount of cash they opened with and the total amount of cash they closed with. So in this question, they opened with 109 total cash, they closed with 4. So there was a cash decrease of how much? 69. They made a loss. So where are these numbers coming from? Let's go and fish them out. Okay. Well, simply come down here and then you say, all right, let me see where those numbers are coming from. So you come down here, you come somewhere here to come and fish those numbers so that you can make sales out of them. So these numbers are coming from somewhere here. So see what we have. Where we go to the current assets, cash, opening cash 117, closing cash 29. Then how about cash equivalents? Cash equivalents you don't know. But there's a hint. See, under current assets, we have a foreign material called investments. This guy is a foreign guy. So it could be the cash equivalent. Or you do simply go to the notes to verify if it's true. So you come here, note number 3. The examiner tells you the current assets investments are government bonds, and management has decided to class them as the cash equivalent. So now you know your cash equivalents. So the cash equivalents are which one? This guys. Opening cash equivalent 46, closing 143. So you're going to say opening cash was how much? Was it 29 plus opening cash equivalent how much? 143. Then you go and remove the bank overdraft of how much? Of 132, the opening bank overdraft. Then you get the figure, which is the 109. Then you come here, you simply say opening cash was 117 plus cash equivalent of 46. Then you remove the bank overdraft, the 54. You have how much? You have 40. The difference, so here you have 40, 109, here you have 40. The difference is how much? 69. That's how you do it. So you can see how we have tackled this question. That's how you must be able to tackle it, even in the exam, or you're dealing with a client or things like that. Okay, I've seen your private message, Mr. Manga. Thank you so much. Okay, so there you go. So you come down here to come and just verify and say, okay, fine, this is what I've been able to do, and that's what I've done. So there we go. Your opening cash and cash equivalent. Opening cash 17, 117, closing cash 29, opening cash equivalent 46, closing cash equivalent 143. When you add this plus this minus that, you have that. So they opened with 109 in cash, they are closing with 49. There's a total decrease of how much? Of 69, which is a bad thing. This company has made what? Cash and cash equivalent decrease of how much? Of 69. So when you add up all these things, starting from here, coming down, 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 all the way up to here. When you add these things up, they should be able to give you 69. That's how it works. Yeah, they should be able to give you 69. So this is why you see I've put this 69 here and that one there. So guys, that's how we do statement of cash flow. So this is the preparation for you to come and do now the advanced statement of cash flows at the master's level. So now we have prepared you what you need to understand. So now our next session, we're going to do now the full consolidated statement of cash flow for a group of companies. Now that one is a bit more involving than this one. So this is a degree level statement of cash flow we have done. I've used this one as an introduction to help you understand what happens. Now, at the master's level, we are now going to go up now to go and do the advanced statement of cash flows to incorporate now group accounts, goodwill, NCI, all those kind of associates are going to be incorporated now so that we can to come up with something more concrete. So, guys, that's how we do these things, and I really hope that you guys have enjoyed yourselves and indeed you've been able to benefit. So if there's any question, guys, I'll be happy to respond. There's a question. That's Moape Chabala. Good evening, sir. Does this lecture relate to advanced financial reporting? Is it from YouTube? Yes, it does. All right. So what we are doing here, we are laying a foundation. I've used a question that is at the degree level, but it's going to help us to build on to the master's level, the advanced financial reporting at the master's level. So yes, it does. Yeah. Okay. Any other question? Any question, guys? Anybody with a question? Are we okay? Banda, Matthew, Mwaba, I will save everything. Okay.
Okay. Okay.
All right, fantastic. So, guys, thank you so very much. So, in our next session, now we're now going to build on the advanced statement of cash flows. All right, we are going to do that. So, guys, thank you so very much for joining me this evening. This is where we end tonight. Our viewers, thank you so much. Have a lovely night. Bye bye.